because if I'm China, America keeps saying we need China to consume more, need China to consume more. China can't consume more until they have the ability to buy their commodities in their own currency. So we're giving them that ability. That is also with the gold settlement going to send gold much, much higher to serve as sort of the neutral reserve asset of this whole system. That's going to improve Chinese balance sheets further, Indian balance sheets further. So now all of a sudden, like, imagine how wealthy 2.8 billion Chinese and Indians are if gold's at $10,000 an ounce, $15,000 an ounce. You think they're going to buy anything out of their factories and the new American factories?
The global monetary shift underway is rewriting decades of financial dominance. As China and India strengthen their gold-backed systems, the stage is being set for a new era of trade and power balance. By settling commodities in local currencies anchored to gold, these nations are insulating themselves from the vulnerabilities of the dollar system. This move will not only lift gold prices to unprecedented levels, possibly $10,000 or even $15,000 an ounce, but also redistribute global wealth. For billions across Asia, stronger gold-backed balance sheets will translate into newfound purchasing power, igniting one of the largest economic booms since the post-World War II recovery. Luke Gromen, a respected macro strategist and founder of Forest for the Trees, has long argued that the next phase of global finance, what he calls Dollar Hegemony 3.0, will prioritize domestic production, defense, and middle-class prosperity over financialization. As the dollar weakens, debt resets, gold will serve as the neutral anchor of stability in a multipolar world. Now, we present the clips from Luke Gromen's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
A gentle decline in gold LBMA volumes around the city, if I'm going from memory, earlier this year, last year. But what I do know is that you could see in U.S. trade statistics starting around December of last year and into the first quarter of this year, somebody was importing so much gold into this country that it had knocked down GDP into a technical recession. In other words, we were importing, and it was gold. There were so many gold imports that the United States, I don't know, whoever tracks that, Bureau of Economic Analysis or Department of Commerce, whoever it was, they were literally stripping gold imports out of the economic data because it made it look like GDP was falling 4% in the first quarter. And when you do the math, again, I'm going from memory here, but I want to say it was like $500 billion in annual, $500 billion at an annualized rate of gold imports. So it was a lot. So somebody was bringing gold, a lot of gold into the United States from somewhere.
We don't know who it is?
We don't know who it is, but having had conversations with various market players over time in that business, and even looking at what we can see publicly throughout history, right? When the Hunt brothers in 1980 tried to create a run on physical silver and the system did not want that to occur, they turned COMEX silver into a sell-only futures market. And they basically said, you're not allowed to do that, right? When you look at COMEX inventories, at any given day, you can look at COMEX inventories, multiply it times the price of gold, and it's, in the grand scheme of things, it's not that much gold. And so in theory, at any moment in time over the last 10, 20, 30 years, any medium-sized hedge fund who are very profit motivated could have showed up at COMEX and said, I'm going to buy all these gold futures. I'm going to demand physical gold delivery. I'm going to break it. And we're going to create this super spike in gold and I'm going to get rich. And yet none of them ever did. And my point here is that gold is a political metal. You don't just get to be a private market player, show up and squeeze gold for all the reasons we just discussed. It's a lot more than just some, pet rock commodity trading thing. It is still a systemically important asset. And so my point here is that whoever was bringing all that gold in had to have been systemically important. So I don't know, and had to effectively have had the blessing of the U.S. government to do that. So whether that was Treasury, whether that was a systemically important financial institution, or in the parlance, too big to fail bank, I don't know. But a gun to my head, I would if I had to guess, it was either the U.S. government or somebody with the U.S. government's blessing or acting as agent for the U.S. government, and specifically the U.S. Treasury. Because if I'm China, America keeps saying we need China to consume more, need China to consume more. China can't consume more until they have the ability to buy their commodities in their own currency. So we're giving them that ability. That is also with the gold settlement going to send gold much, much higher to serve as sort of the neutral reserve asset of this whole system. That's going to improve Chinese balance sheets further, Indian balance sheets further. So now all of a sudden, like, imagine how wealthy 2.8 billion Chinese and Indians are if gold's at $10,000 an ounce, $15,000 an ounce. You think they're going to buy anything out of their factories and the new American factories? Probably. That's why I say if we actually are successful in this move, this de-dollarization spun as US dollar hegemony 3.0, it could be the biggest economic boom in literally since World War II for the whole world. I think it means the biggest economic boom / renaissance since the immediate aftermath of World War II. I think global nominal economic growth it just explodes higher. I think you see we know who the winners and losers were of this iteration of the last 40 years of US dollar hegemony, right? Which is Wall Street, the last 40 years of US dollar hegemony. And I would back up 1 second and say there have been various stages of US dollar hegemony, right? So from 1940 to 1980, what was good for General Motors was good for the United States. That was US dollar hegemony. From 1980 to 2020, what was good for Goldman Sachs and what was good for the US Treasury market was good for America. That was sort of, part two or the second iteration of US dollar hegemony. I think what we're seeing, what China is doing with gold, it will ultimately result in the US dollar hegemony 3.0, which is what's good for the US defense industrial base and the US middle and working class will be good for America. And that'll run from 2020 to 2060 in keeping with the 40-year periods. Why do I say that? Well, let's see who won in US dollar hegemony 2.0. We send our factories and jobs overseas. They send us stuff. We send them dollars. They send the dollars back into our financial markets and specifically treasury markets. And that's how it worked. So who won? China won. Wall Street won. Washington won. Who lost? U.S. defense industrial base lost. We can't make anything here. U.S. working class lost.
China for everything.
Exactly. It's certainly critical components, right? As we saw with rare earths. The U.S. working class lost, and the U.S. middle class lost. So if we're going to listen to what we're seeing every day, America is fundamentally reversing the flows of U.S. dollar hegemony 2.0 under U.S. dollar hegemony 3.0. We're bringing these factories back. We want people to invest here. We're done exporting jobs. We are done being dependent on China to build critical components for the U.S. military. So if we're reversing the flows of U.S. dollar hegemony 2.0, it stands to reason we're going to reverse the beneficiaries, at least on a relative basis. And so if Wall Street, China, and Washington won in U.S. dollar hegemony 2.0, in U.S. dollar hegemony 3.0, who's going to win? The defense industrial base, inflation, gold, the U.S. middle and working class, and America overall. You're going to see if wealth inequality blew out during U.S. dollar hegemony 2.0, it's going to narrow in U.S. dollar hegemony 3.0. Now, so when you overlay that with what you were saying before about the eurodollar market, right? The eurodollar market, at the end of the day, if we wanted to simplify it in a 5-second elevator pitch, is the whole world is massively short dollars. The world's massively short dollars, and the dollar goes down. Everyone in the world gets a debt jubilee. So you're going to get debt jubilee globally as the dollar falls. You're going to get a reshoring here, expansion of middle working class, reinvestment, inflation, and the inflation and the yield curve control on the inflation is why the dollar is going to fall in part. It's win-win-win. It's win-win-win except for treasury holders. It's interesting, this dynamic that I highlighted with gold. You can see it already empirically working in Russia, right? Russia had FX reserves seized at the beginning of the war. They have fought this very expensive war, and yet Russian FX reserves and foreign debt levels, Russian FX reserves are at the highest level in ever, going back at least 40. The price of gold just keeps going up, right? They're basically, they keep settling in gold, and gold reserves keep rising, right? So the value of the ruble keeps falling against gold, but essentially what they've been doing is revaluing their gold reserves higher using their oil production. It's just the flip side of the coin to the China dynamic we discussed earlier. So I think the Russian economy it's running as a war economy. It is hot. It is inflationary. They're doing what they can to manage the inflation. And ultimately, as long as China is willing to stand by them and continue to supply them, it is I think they've got the stronger hand.
Across the global monetary landscape, a quiet yet powerful transformation is underway. Major economies, particularly in Asia, are shifting toward gold as the ultimate foundation of stability. Official figures understate the reality. Central banks, such as those of China, Russia, and India, likely hold far more gold than they publicly report. This hidden accumulation represents a deliberate strategy to insulate national wealth from the relentless erosion caused by negative real rates and dollar-based debt dependency. For nations holding U.S. treasuries, the math no longer works. Storing reserves in assets that lose purchasing power is no longer a viable option. What's emerging instead is a new trade architecture anchored by gold. Through yuan-based commodity settlements redeemable in physical metal, China has built a self-sustaining system, one that allows partners to trade outside the dollar while preserving purchasing power in real terms. This virtuous cycle strengthens balance sheets across Asia, drives gold demand structurally higher, and weakens the foundations of fiat-based hegemony. Let's get back to the interview.
They are, in all likelihood, particularly China, Russia, India, are holding much more gold on an official basis than they have declared. There are ways. There's official gold, and then there's gold owned by the government that they have not necessarily declared. So in the case of China, they have different sovereign wealth funds. They have the official central bank FX reserves, but then there are other sovereign wealth funds that may be absolutely controlled by the PBOC or the CCP, but whose gold holdings is not necessarily tallied for official for whatever reason that may be. I do think they are. Those numbers don't exactly make sense. It is a relatively opaque market. Why are they buying it? They are buying gold for two reasons, two primary reasons. China in particular, but others as well. The first is that it has become very apparent to, I think, everybody around the world, most everyone around the world, certainly at that level, that over the last 5 to 10 years, the only way the U.S. and the West more broadly can afford to sustain their debt levels is by having negative real interest rates. In other words, having the rate of inflation, nominal growth higher than the interest rate on the bonds. And so if you are a creditor of the United States, storing the wealth of your country in bonds whose rate of inflation is below, or whose rate of interest, is below the rate of inflation, that amounts to effectively a slow expropriation of your nation's wealth by the Americans. And that's not acceptable to any number of other countries. And so the way you combat that is you own gold. Gold preserves your purchasing power over time. The other major reason they're doing this, and have been for over a decade, particularly as it relates to China and Russia, is that with the weaponization of the dollar and with the position that China and to a lesser extent Russia are in, China does have a very serious issue that's been identified over the last 10, 12 years by a number of different people, which is if, as they continue to grow their economy, they need to buy and import more and more oil and other commodities, and I'll just say oil for short, they need to import more oil to support the growth of their economy and support the amount of debt that they have. The challenge for China is that China has a finite number of dollars in their FX reserves, and oil, up until a few years back, was only priced in dollars. And so as China was facing a situation about 10, 12 years ago where they were looking forward to say, okay, well, we need to keep growing in order to, sustain our debt and maintain political legitimacy in China. And so we're going to be importing more and more oil and other commodities, and probably means oil prices are going to be going up over time. And so as we import more oil at higher prices, all in dollars, against our finite store of dollars, we're going to run out of dollars. And when we run out of dollars, we are going to have a late 1990s Southeast Asia currency crisis. We're going to have to devalue the yuan. We're going to have high rates of inflation. We're going to have a very big drop in living standards. And that is a serious crisis that would lead to questions about political legitimacy in China. And that is simply a non-starter. And so the problem is that while they recognize that problem, they also want to not open up their capital account. They do not want to have free flow of capital in and out of China because they're afraid of a run on yuan that way. And so what they did is come upon a pretty innovative solution, elegant solution, which is they have spent the last 10, 15 years establishing offshore yuan clearing banks and finding oil exporters and other commodity exporters willing to sell the marginal barrel of oil and other commodities in Chinese yuan. Now, why would Russia sell oil in yuan? As much as Putin may not be happy with the US these days, he would still trust dollars over yuan. And the answer is China has provided for net settlement of yuan surpluses that oil exporters would earn in this case in physical gold. So if you are Russia and, oh, by the way, you're getting sanctioned by the West, so you're looking for ways around the dollar system, Russia can sell oil in yuan. They end up with yuan surpluses from selling that oil. And the system that the Chinese and the Russians have been working on for over a decade has been surplus yuan can be used to buy all the goods that are made in China, the factory of the world, and which are getting to be higher and higher quality goods. And if Russia or whoever else still has yuan left over by virtue of this trade, they can recycle that into gold that floats in Chinese yuan terms. And that's a really important part of the deal because no one may trust the Chinese government, but everybody trusts gold more than the dollar. China, the price of gold is allowed to float in yuan. There is no fixed rate that China is exchanging this at. And that is important because Treasury Secretary Connolly in 1970 famously said the dollar is our currency, but it's your problem. In other words, we're going to run these deficits, we're going to inflate, and there's nothing you can do about it. You're just going to have to eat it with your debt holdings. The Chinese, the way they're treating gold, allowing yuan gold to float in yuan terms is, hey, sell us oil in yuan. If you end up with net yuan surpluses, you can buy gold with it at these offshore clearing banks around the world, which, oh, by the way, are located in gold trading or refining hubs like London, Singapore, Dubai, Switzerland. And then the gold will go up or down based on how we manage our finances. And so if we, the Chinese government, keep inflating, then the price of gold in yuan is going to go up. Your purchasing power of the gold reserves you have from doing trade with China is going to buy you more stuff from China. So it's the yuan is our currency and it's our problem. Basically, it sets up a virtuous cycle of trade, whereas the American, our currency, but your problem requires the Americans to take purchasing power from treasury holders. The Chinese system, as they have set up, allows gold to rise to preserve and or grow purchasing power in yuan terms for their creditors, which then has them buy more yuan goods, which then has China buy more oil, which means you get this virtuous cycle trade. So that's change number one. The other thing the Chinese did that's pretty elegant is the Chinese aren't allowing gold in mainland China to circulate to settle this trade. In other words, once physical gold goes into mainland China, it can't leave. There are still capital controls on gold. Hong Kong, it can come and go. The Shanghai Gold Exchange International Board in Shanghai, there's a free trade zone where gold can come and go. And so essentially, China is using the gold in London, the gold in New York, and the gold. They're essentially creating a short squeeze in gold. Gold price is higher because their gold is not allowed to move. So they can't run out of gold. And oh, by the way, because they've been encouraging their citizens to buy gold since 2002, the government has.
The global monetary landscape is reaching a breaking point. The era of unchecked debt and paper promises is giving way to something older, more substantial, and far more honest: real value. As fiat currencies lose credibility, gold is stepping back into the role it was always meant to play: the stabilizer of civilizations. The accumulation by central banks is no coincidence. It's preparation for what comes next. The fading trust, the currency dilution, and the silent shift from financial assets to tangible reserves. This transition won't be smooth, but it will be defining. The world is moving toward a multipolar system where gold once again underpins trade, credit, and confidence. For investors, that means the rules of wealth preservation are being rewritten in real time. When paper fails, only what's real endures. The question is no longer if the reset comes, it's whether you'll be positioned when it does. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.